Let me tell you something most traders don't want to hear. Consistency in trading is not about strategy. It's not about finding the perfect indicator. It's not about catching every breakout. It's not about predicting the market correctly. Consistency is behavioral, and that's uncomfortable because behavior is harder to fix than strategy. Most traders think they're inconsistent because they haven't found the right setup yet. But the truth is simpler. They haven't built the right habits. You don't become consistent by winning more trades. You become consistent by behaving the same way on every trade, win or lose. That's rule number one. Consistency starts with identical execution. If your rules say risk 1% per trade, you risk 1%, not 2%, because you feel good. Not 0.5% because you see strong momentum. Not 0.5% because you're scared. The moment your execution changes based on emotion, consistency disappears. You don't need a perfect system. You need repeatable behavior. Rule number two, risk control is more important than accuracy. Most traders obsess over win rate. They want to be right 70% of the time. They want to feel confident. They want to prove something, but consistency doesn't care about ego. It cares about math. You can be right 50% of the time and grow steadily. If your winners are larger than your losers, if your losses are controlled, if your size is consistent, but if you win 70% of the time and let losses run wild, you'll still fail long term. Consistency is about protection first, profit second. That order matters. Rule number three, you must define what a good day actually means. For most beginners, a good day equals profit. That's dangerous, because some green days are undisciplined, and some red days are perfectly executed. If you followed your rules, respected your stop, and executed properly, that's a good day, even if it's red. If you made money but broke your rules, that's not a good day. It's a warning. You must train your brain to reward discipline, not outcome. Because outcomes fluctuate. Discipline compounds. Rule number four, eliminate randomness. If your trading feels chaotic, your process probably is. Do you trade at random times? Do you take random setups? Do you change position size randomly? Do you switch strategies during drawdowns? Random behavior creates random results. Consistency requires structure. Trade the same session. Use the same setups. Follow the same checklist. Review the same metrics. Structure reduces emotional interference, and emotional interference is the enemy of consistency. Rule number five, accept losses immediately. The fastest way to destroy consistency is refusing to accept small losses. You hesitate, you move stops, you hope. Hope is not part of professional trading. Small losses are controlled damage, big losses are emotional decisions. If you can't accept being wrong quickly, you will never become consistent. Being wrong is neutral. It's statistical. Detach your identity from the trade. You are not your last position. You are your long-term behavior. Rule number six, stop trading for excitement. This one is subtle but powerful. If you enjoy the adrenaline of volatility, if you need constant action, if you feel bored when you're not in a trade, consistency will be hard. Professional trading is repetitive. It's selective. It's patient. It's often boring. Boring is good, because boring means controlled. Excitement leads to overtrading. Overtrading leads to inconsistency. Rule number seven, measure performance monthly, not emotionally. Most traders live inside daily results. They feel amazing on green days, terrible on red days. That emotional swing destroys stability. Zoom out, track weekly metrics, track drawdown percentage. Judge performance based on data, not feeling. Feelings fluctuate faster than markets. Rule number eight, have a maximum loss limit. Daily, weekly, monthly. Define it before you trade. When you hit it, you stop. No negotiation. No revenge trade. No doubling size to recover. Stopping protects your psychology. And protected psychology produces consistency. Rule number nine, review behavior, not just charts. Most traders review technical entries. Few review emotional decisions. Ask yourself, did I follow my plan? Did I hesitate? Did I rush? Did I size correctly? Did I respect my stop? Behavioral review builds awareness. Awareness builds control. Rule number 10, detach from short-term identity. You are not a genius because you had a green week. You are not a failure because you had a red week. Consistency requires emotional neutrality. Calm during wins, calm during losses. Stable mindset produces stable execution. Stable execution produces stable results. And stable results are the definition of consistency. Let me say something clearly. Most traders don't lack knowledge. They lack control. They know they should risk 1%. They know they shouldn't overtrade. But knowing is not doing. Consistency is not about information. It's about repetition. You repeat disciplined behavior long enough, and your equity curve smooths out. You repeat emotional behavior long enough, and your account fluctuates wildly. The market rewards repetition, but it punishes emotional inconsistency. If you truly want consistent trading, stop chasing more setups. Start mastering your behavior, because consistency is not found. It's built. And in the next part, we're going to go deeper into the psychological traps that quietly destroy consistency, even for traders who think they're disciplined. Now let's go deeper, because knowing the rules is one thing. Living them every single trading day is something else entirely. Most traders don't fail because they lack principles. They fail because they abandon them under pressure. Pressure is where consistency breaks, and pressure shows up in predictable ways. One of the biggest psychological traps is performance anxiety. After a strong week, you feel pressure to maintain it. After a weak week, you feel pressure to recover. Both situations create emotional urgency, and urgency leads to forced trades. When you're trying to maintain a winning streak, you hesitate to take small losses. When you're trying to recover a losing streak, you increase size to get back on track. In both cases, your behavior changes, and consistency disappears. Real consistency means treating every week the same, not emotionally reacting to streaks. Streaks are part of probability. Your job is not to eliminate streaks. Your job is to remain stable during them. Another trap that quietly destroys consistency is overconfidence. Overconfidence doesn't feel dangerous. It feels earned. You string together a series of clean trades, your account grows, you start thinking you've figured something out that others haven't. You loosen one rule, then you increase size slightly because the setup is obvious. You skip journaling because you already know what you're doing. It fades. That's why it's hard to notice until damage is done. The opposite trap is self-doubt. After a few red days, your confidence drops. You start second-guessing valid setups. You reduce size inconsistently. You hesitate at the exact moment your system signals entry. You miss clean trades. Then frustration builds. And frustration leads to impulsive entries later. Consistency requires trusting your tested process, not your emotional state. Your emotional state changes daily. Your tested process should not. Another silent killer of consistency is inconsistency in preparation. Some days you review thoroughly before the market opens. Other days you rush into the session unprepared. Some days you follow your checklist. Other days you trade casually. Preparation sets the tone. Lack of preparation creates reactive behavior. Reactive traders are rarely consistent. Consistent traders are proactive. They define their plan before volatility begins. Let's talk about environment. Your physical and mental environment directly impacts execution. Are you trading distracted? Are notifications constantly interrupting you? Are you tired? Are you stressed from unrelated life issues? Discipline becomes harder when your environment is chaotic. Consistency requires controlled conditions. You don't need perfection, but you do need intentional structure. Same workspace, same routine, same process. Predictability reduces emotional volatility, and emotional volatility destroys consistency. Now let's discuss something deeper. Your relationship with money. If you view trading as a way to escape financial pressure, your decisions will carry urgency. Urgency creates emotional attachment. Emotional attachment creates fear. Fear leads to premature exits or refusal to take losses. If your financial survival depends entirely on daily trading performance, stability becomes difficult. Consistency thrives when pressure is manageable. That doesn't mean you avoid responsibility. It means you build skill before you build dependency. Another psychological trap is comparing yourself to others. You see traders posting large gains. You hear about accounts doubling. You begin questioning your steady growth. You feel behind. Comparison introduces emotional noise, and emotional noise leads to unnecessary risk-taking. Consistency is personal. Your metrics matter more than someone else's screenshots. You're not competing against other traders, you're competing against your past behavior. If you're more disciplined today than last month, that's progress. Consistency compounds quietly. It doesn't scream, it builds. Let's talk about expectations. If you expect trading to be exciting every day, you will sabotage consistency. Some days will be slow, some weeks will be flat, some months will test patience. That's normal. Consistency requires accepting normal market conditions without emotional reaction. You don't need constant action. You need controlled action. Overtrading is one of the clearest signs of inconsistency. When you take trades outside your defined edge, you dilute your statistical advantage. Even good traders destroy performance by adding unnecessary trades. Every trade must earn its place. Another subtle issue is goal setting. If your goal is outcome-based, like make $5,000 this month, you will subconsciously force performance. Better goals are behavior-based. Follow your plan daily. Maintain risk limits. Complete your journal every session. Behavior-based goals produce consistent outcomes. Outcome-based goals produce emotional pressure. Consistency is built on repeatable behaviors, not forced targets. Let's examine drawdowns. Every strategy experiences drawdowns. The difference between consistent and inconsistent traders is response. Inconsistent traders panic during drawdowns. They change systems. They increase risk to recover faster. They abandon tested rules. Consistent traders reduce size. They analyze performance. They wait for clarity. They stay inside structure. Drawdowns are not failures. They are statistical inevitabilities during them. Now here's something critical. You cannot build consistency if you avoid self-accountability. Excuses destroy growth. Blaming the market destroys growth. Ownership builds consistency. When you take full responsibility for your execution, you regain control. Control stabilizes behavior. Stabilized behavior stabilizes results. Another layer to this is self-awareness. You must know your weaknesses. Do you struggle after losses? Do you get overly confident after wins? Do you trade more when bored? Do you hesitate under pressure? Identify patterns. Write them down. Awareness creates intervention. Intervention builds discipline. Discipline creates consistency. Let's talk about longevity. Consistency isn't about having one great month. It's about repeating acceptable performance over years. Think long term. If you protect capital, manage risk, and execute cleanly over time, growth becomes natural. Consistency is not explosive, it's steady. And steady growth builds real confidence. Not emotional confidence. Process confidence. Process co. Confidence is stable. It doesn't depend on today's profit, it depends on long-term behavior. And that's the foundation of sustainable trading. In the next part, we're going to lock everything together. We'll talk about how consistent traders think differently at a deeper level, and why mindset determines whether these principles stick or fade under pressure. Now let's bring everything together, because consistency is not built in one decision. It's built in thousands of small ones. And the difference between traders who stay consistent and those who don't is rarely intelligence. It's identity. Consistent traders see themselves differently. They don't see themselves as gamblers trying to catch moves. They see themselves as risk managers. That shift changes everything. When you identify as a risk manager, your first instinct is protection. Protection of capital, protection of long-term performance. Every trade becomes a calculated exposure, not a chance to prove something. And when your identity shifts, your behavior aligns automatically. You no longer need motivation. You operate from structure. Another powerful difference is emotional pacing. Inconsistent traders react instantly. Market moves. They respond emotionally. Consistent traders pause. They think. They follow a defined process. That pause is powerful. It creates separation between impulse and action. And in trading, that separation protects you. Consistency also depends on tolerance for imperfection. You will never execute perfectly. There will always be small mistakes. There will always be missed entries. There will always be trades that barely stop you out before moving in your direction. If you obsess over perfection, frustration builds. Frustration leads to overcorrection. Overcorrection leads to inconsistency. Accept imperfection. Focus on maintaining statistical edge. Edge does. To require perfection, it requires repetition. Another mindset shift is understanding that slow growth is real growth. Fast gains feel exciting, but they often come with unstable risk. Slow growth feels boring, but it compounds safely. If your account grows steadily at controlled risk, that is success. Consistency is measured by smoothness, not speed. Now let's talk about self-trust. Self-trust is earned. You earn it by following your rules repeatedly. Every time you respect your stop, you build self-trust. Every time you avoid overtrading, you build self-trust. Every time you close the platform after hitting your daily limit, you build self-trust. Self-trust reduces hesitation. Reduced hesitation improves execution. Improved execution strengthens consistency. It's a cycle, a positive one, but there's also a negative cycle. Break rules. Feel regret. Lose confidence. Hesitate next trade. Force recovery. Repeat mistakes. That cycle destroys consistency. Breaking that cycle requires commitment to process over ego. Let's address something important. Motivation fades. Discipline remains. If your consistency depends on feeling inspired, you will struggle. Some days you won't feel focused. Some days you'll doubt yourself. Consistency means following your plan anyway, not because you feel strong, but because the structure is stronger than your mood. Structure replaces motivation, and structure is reliable. Another key difference is long-term thinking. Inconsistent traders think trade to trade. Consistent traders think quarter to quarter. They evaluate performance over months. They look for trends in behavior. They refine small inefficiencies. They don't panic over short-term fluctuations. Zooming out stabilizes perspective. When you zoom out, emotional swings shrink. Let's talk about pressure again. Pressure never fully disappears. As your account grows, stakes increase. But consistent traders adapt. They scale gradually. They adjust position size responsibly. They don't rush growth. They respect capital. Respect is powerful. When you respect your capital, you treat it differently. You don't risk it carelessly. You don't revenge trade with it. You don't chase with it. You manage it. Management creates stability, and stability produces consistency. Another major factor is routine. Routine reduces decision fatigue. When you trade the same session, follow the same checklist, review the same metrics, your brain conserves energy. Less energy wasted means fewer impulsive decisions. Consistency thrives in predictable structure. Now let's talk about emotional detachment. Emotional detachment does not mean you don't care. It means you don't attach your identity to outcomes. You win, you log it, you move on. You lose, you log it, you move on. The trade is not personal, it's statistical. Detachment prevents overreaction. Overreaction destroys consistency. Another layer to this is patience. Patience is underrated in trading. Waiting for high-quality setups, waiting for clarity, waiting for volatility to settle. Impatience causes forced entries. Forced entries increase randomness. Randomness eliminates consistency. The consistent trader waits. Selectivity is edge. You don't need many trades. You need the right trades. That mindset reduces stress. Less stress improves clarity. Clear decisions support steady growth. Let's be honest. Most traders want excitement. They want fast growth. They want dramatic equity curves. But dramatic curves usually mean dramatic drawdowns. Smooth curves mean discipline. Discipline isn't flashy, but it lasts. And lasting matters more than speed. Here's the final truth. Consistency is a lifestyle, not a tactic. It reflects how you handle pressure, how you handle boredom, how you handle success. What you handle failure. If you're emotionally reactive in life, you'll likely be reactive in trading. Improving consistency may require improving personal discipline outside the charts. Sleep schedule, exercise, mental clarity, focus. All of it matters. Trading exposes your habits. It magnifies weaknesses. But it also rewards growth. If you commit to these principles, if you prioritize protection over ego, if you measure discipline over daily profit, if you build identity around risk management, consistency stops being mysterious. It becomes mechanical. And mechanical execution is powerful, because mechanical execution removes emotional chaos. And when emotional chaos disappears, your results stabilize. Not overnight, but gradually, and gradual stability is what builds real confidence. Not hype, not luck, not temporary streaks. Real confidence, the kind that doesn't disappear after a red week. That's trading consistency. It's not built by finding the perfect strategy. It's built by mastering yourself. And once you do that, the numbers follow. Steadily, predictably, quietly. That's the difference between someone who trades occasionally and someone who operates consistently. Consistency is not complicated. It's disciplined repetition. And disciplined repetition is a choice you make every single trading day.